Hello, welcome to our continued analysis of PepsiCo's 2014 annual report. We're going to be talking about inventory costing methods and inventory ratios, which is analogous to information in Chapter 6 of your textbook. So, looking through PepsiCo's annual report, we need to dig a bit deeper to get more information about inventory. We'll start with the balance sheet, look at page 71 of the 10K, which is after the first part of the annual report. Look at the number page 71 on the bottom. And the footnotes are notes 2 and note 14. So, the consolidated balance sheet, I've taken the asset side of it, and you'll see there's just one line for inventory. That line says there's $3.1 billion worth of inventory in 2014 and $3.4 billion in 2013. So we have to dig a little deeper. Every company that has an annual report that has publicly held stock has to disclose significant accounting policies. Pepsi discloses several pages of information about its accounting policies in footnote 2, but it just has a little bit about inventory and asked you to look further later on at note 14, which we will. In general, they will tell you something that every single company that uses U.S. generally accepted accounting principles, which is called U.S. GAAP as an acronym, or even International Financial Reporting Standards, or IFRS as an acronym. Every company basically reports its inventory at the lower of cost or market. Another word for this is called LOCOM. How do you determine cost? Well, we want to make sure that the cost does not exceed what we could sell it for. This is rare that it happens that what you bought something for or what you made it for is higher than what you could sell it for. But if it does, you mark it back down to the market price. Most of the time, most of the inventory is at cost because what it cost you to buy it or make it is much less than what you could sell it for. If we are using a costing method, for PepsiCo, a company that makes many similar items, they'll choose something like the average cost method, the first in, first out or FIFO method, or the last in, first out or LIFO method. As a matter of fact, you will see that for real companies like PepsiCo, they may choose more than one of the costing methods for different types of inventory. So they have lots of subsidiaries, lots of product lines. Some of them might be costed at average cost, some at first in, first out, or FIFO method, others at last in, first out, or the LIFO methods. Pepsi doesn't have a lot of inventory at the LIFO method, which we'll see as we further analyze note 14. So in general, they're choosing among these costing methods used when you have many similar items. PepsiCo would not use the specific identification method for inventory because they don't produce lots of unique items like a custom jeweler would. So digging into note 14, we look toward the bottom and we see information about our inventories. Because Pepsi manufactures its own inventory, there's information about raw materials. A little over half its inventory is raw materials. Sugar for soda, corn for chips, for Fritos or Doritos. Some of it is work in process, which means work that, a batch of something that is mixed but not baked or packaged. And finally, a little less than half of it is finished goods. So, they also tell you that very little is using the LIFO method. Normally, a company that uses the last in first method is required to disclose something called the LIFO reserve, which was talked about in your book, which gives you the difference between the LIFO and FIFO costing methods as affects the ending inventory. Since PepsiCo had very little of its inventory cost using LIFO, it does not have to disclose the LIFO reserve if it's immaterial. Let's use this for analysis. First ratio is inventory turnover, cost of goods sold from the income statement, average inventory from the balance sheet for this and last year. For PepsiCo, when we get these two items, cost of goods sold from the income statement, we get this and last year's ending inventory from the balance sheet this year. Each balance sheet has 2 years of disclosure. In order to get the 2012 ending inventory, I looked at the prior year's annual report. I'm not asking you to do this. I'm asking you to calculate inventory for 1 year, which you can do using the most recent annual report. So PepsiCo had an inventory of 9.4 times in 2014. Higher inventory, meaning selling your inventory more on average, indicates that you are efficient at managing your inventory, other things being equal. If each sale is profitable, this would lead to more net income. As an investor, I would rather own a company that turns its inventory over 9.4 times in a year than one that only sells it 8.9 times. Using inventory turnover, PepsiCo was more efficient in 2014 than in 2013. Again, a rule of thumb for inventory turnover is if you turn your inventory over 12 times a year, that's about once a month. So PepsiCo is less than once a month, or less than 30 days. A ratio that is analogous, it's based on the same information but easier to understand, is the inventory days in inventory. For this ratio, you'll need this year's income statement and this and last year's balance sheet, but we already have that from the prior slide's calculation. So take the number of days in the year, divide by the inventory turnover ratio. If inventory turnover ratio is 9.4 times a year, days in inventory is 39 days, a little over a month. In 2013, inventory turned over less times, 8.9 times, so it took an extra 2 days to sell inventory on average. So, on average, PepsiCo sold its inventory every 39 days in 2014. Lower days of inventory indicates more efficient inventory management, other things being equal. We said if each sale is profitable, this would lead to more net income. Using days in inventory, PepsiCo was more efficient in 2014 than in 2013. People, especially people that don't read financial statements, often find the days in inventory easier to understand than inventory turnover. For an accounting student, it's a little trickier, one more step to calculate. So, I hope you've learned something from our inventory costing analysis and the ratios. Feel free to use this presentation as a review before finding the inventory costing ratio methods and calculating the days in inventory for your chosen company for 1 year. You'll compare it for the discussion to a company in a different industry and to PepsiCo. And good luck and get started, Jaspers.